All right, let's talk about something that affects every single one of us, risk. It's this invisible force that can seriously throw our lives off track. But understanding it, that's the very first step to getting a handle on it. So let's dive in.
So let me ask you something, straight up. Just think about your savings, your income, your plans for the next few years. If something completely unexpected happened tomorrow, could all of that survive a major hit? It's a heavy question, I know, but it's the one we've got to face if we want to build real, lasting financial stability.
Okay, so before we can start building up our defenses, we've got to know what we're up against, right? So in this first part, we're going to look at what that shock to the system actually is. What are those common curveballs that make us financially vulnerable? And what happens when they actually hit?
And when you look at this list, what's wild is how normal these things are. They can be really personal, like getting laid off, or a big medical bill that comes out of nowhere. It could be something physical, like your roof getting damaged in a storm. Or it could be way bigger, like a market crash or a recession that affects, well, pretty much everyone. These aren't just concepts. They're real things that happen to real people, a lot of the time with zero warning.
And this is where things can get really tough. It's this domino effect. A shock hits, and if you're not ready for it, your choices start to get pretty painful. You might have to sell things you never wanted to sell, maybe your car, maybe even your home. Or you could end up taking on some really high-interest debt just to cover the bills, or cutting back on absolute essentials. It's a tough cycle that a good plan can help you steer clear of.
All right, so I know that all sounds a little intimidating. But here's the good part. There are absolutely things we can do about it. So in this next section, we're going to talk about how to build your own financial shield using the core ideas of risk management.
So what even is risk management? Sounds kind of corporate, right? But really, it boils down to a super simple three-step idea. First, you just identify what could go wrong. Second, you get a sense of how bad it could be. And third, you actively take steps to make it less bad if it does happen. It's all about playing offense instead of defense.
And how do we actually do that? Well, with this protective toolkit, we've got three main strategies we're going to break down. First, you can transfer the risk. That's exactly what insurance is for. Second, you can spread the risk, which is all about diversification. And third, you can prepare for risk. And that means having a solid contingency plan. These three tools right here, they're the foundation of your entire financial shield.
Okay, let's grab that first tool from our kit, insurance. We all pay for it, but do we really get how it works? It feels almost like magic, but it's not. It all comes down to a really cool idea called risk pooling.
Yeah, exactly. Insurance isn't magic, it's just math and community, really. The whole system works by taking a small amount of money, your premium, from a huge group of people. That way, there's enough cash to cover the massive, unexpected costs that, statistically, only a few people in that group will actually have to deal with.
Okay, let's put some real numbers on this to see how it plays out. Imagine you have an insurance group with 10,000 homeowners. Looking at the data over time, the insurance company figures, okay, we can probably expect about 20 of these homes to have a fire this year. And the average cost to fix everything up is around 200,000 dirhams.
So how much money does the insurer need to have ready? Well, you just do the math. You take those 20 expected fires and multiply that by the 200,000 dirham average repair cost. That comes out to a grand total of 4 million dirhams that the group needs to cover for the whole year.
And this is the incredible part. That huge 4 million dirham risk, it doesn't fall on one person. It gets spread out across all 10,000 homeowners. So when you divide that massive potential cost by all the people in the pool, each person's share, their premium, is just around 400 dirhams for the year. That small, predictable payment protects every single person from a devastating 200,000 dirham loss. That's transferring risk. It's brilliant.
But insurance isn't the whole story. It's just one piece of the puzzle. Now let's get into the stuff that you have direct control over every single day. We're talking about building your own Plan B through diversification and smart planning.
You've heard this a million times, but it is so true. Don't put all your eggs in one basket. That's really the heart of diversification. Whether it's having more than one source of income, spreading your investments across different things like stocks and real estate, or even just where you keep your savings, the goal is to spread things out so that one single problem can't bring the whole house down. And look at this. This makes it super clear when you think about your income. On one side, you have the high-risk setup. 100% of your money comes from one job. If that job disappears, your income goes to zero. Ouch. Now look at the other side. Here, the income is spread out. Some from a job, some from investments, maybe a little from a side gig. If the main job goes away, it still hurts, for sure, but it's not a total wipeout. There's a cushion. Okay, so you've got insurance to transfer risk, you've got diversification to spread it out. What's the last piece? It's your contingency plan. This is your break glass in case of emergency playbook. And it's more than just having some money tucked away. It's knowing exactly what steps to take. Like your plan might literally say, if I lose my job, step 1 is pause all subscriptions, step 2 is call the phone company to get a cheaper plan, and step 3 is use this exact amount from savings. It lets you act fast and smart instead of just reacting out of panic.
All right, so we've got these 3 powerful tools. Let's put them all together now and see what our blueprint for financial stability really looks like when it's fully assembled.
Remember that financial shield we mentioned at the beginning? Well, it's not just one thing. Think of it more like having multiple layers of armor. Each tool we've just talked about gives you a different but totally essential layer of protection.
And there you have it, the 3 pillars holding up your financial security. You've got insurance, which takes care of those massive, specific hits that could otherwise be ruinous. You've got diversification, which spreads out your risk so no single problem can sink you. And you've got your contingency plan, your ready-to-go, disciplined response for when things get tough. Put them together, and you've got resilience.
So there's the blueprint. The design for a really strong financial shield is right there. The only question left, and it's one only you can answer, is how strong is yours? Thanks for watching.